Welcome to the Off the Tape podcast. Guy Adami, always joined by the great Kaitlin Malin, the Chief Operating Officer of iConnections. Today, we got a bit of a treat here, Kaitlin. Roy Niederhoffer is joining us, and your backstory is amazing. But Kaitlin, how are you?
I'm doing well. It's disgusting and rainy outside, but we're inside in your beautiful studio.
It is miserable outside. It is, Seattle has made its way to New York, but that's neither here nor there. I don't want to hear about droughts anymore. But Roy, before we get into it, you have a fascinating backstory. So spend some time letting our audience know who you are and how you've gotten to where you are, because I find it really interesting.
Sure. I began my business career at a relatively young age. I was 13 years old. And I fell in love with computers, and I taught myself to program. And the first big program I wrote was a version of the game Space Invaders.
Walk us through how you got from that point as a 13-year-old and probably, 1980 or so to where you are now.
Exactly. That was 1979. And before too long, we had a whole catalog of programs. And then we got an order to produce 350 titles in 1 year. And so that really expanded rapidly. And I eventually had about 30 of my friends and schoolmates working for me by the time I was 16 or 17. And I had a little money to invest because of that. And, it's funny, that became a formative experience for me because I remember writing away for the Vanguard catalog of mutual funds. And I thought, what kind of idiot would invest in stock? Because no one had made any money in stocks for the last 10 years. And even for much longer than that. I had a grandfather who recently passed in 1979 who told me his stories about getting wiped out in the market crash. He said, whatever you do, don't buy stocks. Do not be an equity investor. And of course, these were times of tremendous inflation, and we just had gas rationing. So I thought, oh, wow, look at these high yield bonds that they have 11% interest. So I put all my money, or what I guess now a little money, but back then it was a lot, in bonds. So I had this crazy formative experience of stocks in a bear market and incredible inflation at the same time. And, it took a while, but that came back in a couple of years ago. So that was my beginnings. I also had a very interesting opportunity to learn the markets from a different source. My brother Victor was an early behavioral economist before there was the word behavioral economics. He had a PhD from the University of Chicago, and by the 70s had a firm that was doing commodity speculation using systematic strategies that were based on some of his work. And so there was this family business that was doing commodity trading. And that's in fact where I got exposure to computers for the first time as well. So I had this organic exposure to trading and short-term trading. And I then went off to Harvard and studied neuroscience, and I came very, very close to going off to Cambridge and studying actually brain-machine interfaces. It would have been a long career, but finally, after about 40 years, they're making some good progress. But basically, I wanted to look at using electroencephalography to measure the human brain's activity and see if you can do anything interesting with that. But it would have been a very tough career for me had I gone in that direction. But fortunately, my brother made me an offer I couldn't refuse in 1987 to come and work for him and program and develop trading strategies. And that ended up being my career.
That's amazing. Why don't you tell us a bit? How do you make that pivot going from neuroscience into investing? How much does your background and what you studied play into how you approach investing?
Well, at the beginning, I didn't really recognize that there was a connection. And that was to my, it was very costly because I found that in my first efforts, I was making a lot of very emotional mistakes. And the kind of mistakes that every neophyte trader makes. I was getting out too soon. I was panicking. I was really, I was susceptible to all of the very behavioral biases that I just spent 4 years learning about until it occurred to me that, hey, wait a minute. I think I know what's going wrong here. And so I began trying to quantify some of the things that I had learned in neuroscience, some of the things that, especially that Daniel Kahneman and Tversky had articulated in some of the things that they had published even then. They were recognized as real pioneers of behavioral economics. And it took me several years to really think about where this nexus lay. But by the time I started my own firm 5 years later, I'd had this interesting experience where I started investing in inflationary bear market. 6 weeks into my career in 1987, the market had crashed, and we had this incredible burst of fear in one day that wiped so many people out. That shouldn't have happened, but it did. And 5 years later, I had developed a way of finding these behavioral effects in the historical price database that my brother had begun collecting in the 70s, literally by hand. We had people back then sitting there watching the prices, and you couldn't collect them automatically back then, but people would actually write in very large ledger books every half hour. And he has them back to the probably 1976 or something like that. And obviously it was different maybe by the 80s, but back then it was all done by hand. And so the patterns that we follow even then were quantifications of behavioral ideas.
Speak to real quick, how do you extract the emotion that every human being feels from the day-to-day or just the trading? Because that's the most difficult thing to do. Now, I understand to a large extent, if things are automated, that helps a great deal. But as human beings, we're emotional creatures. And as you said earlier, the mistakes that you make are seemingly the mistakes that everybody makes over and over again, vis-a-vis the emotion that takes over.
A good way to think about behavioral biases and what kinds of things we look at would be to ask the question, if you were to describe to someone at the end of the trading day what happened in the markets today, the very same things that you would point out, like, oh, the stock market, it looked terrible at the beginning of the day, but then there was a huge rally, and it looked awful at noon, but then it rallied 2%, and yeah, there it goes up again, as it's done every day for the last 3 or 4 days. Okay, so what have you articulated there? You've articulated a surprise. You've articulated that shorts might have gotten really hammered, and a big consensus change, or the consensus bias change. You've articulated a certain habituation of the market to the fact that it rallies every day, and people begin to anticipate that. So that's probably changed psychology. You've sort of said, okay, well, the market's on a new high again. So now you have people anchored to this trend and maybe the very high price of the trend. And you start to see how these words begin to match the psychological qualities that you hear when people talk about human cognitive biases. So what we'll try to do is we'll develop rules that we can test and say, well, what is it? What happens in these situations across all the markets of all asset classes going back decades? And when we find repeating patterns that have occurred thousands, tens of thousands, even hundreds of thousands of times in this intraday price database, that becomes a place where we begin. Now, it used to be that you could be very, very simple and ask the most basic questions. And believe it or not, some of those very simple ideas that I was finding in the 80s that we were trading on back then are still there in the market with tremendous degrees of statistical significance. But I guess the best way to put it is it's a little bit like the way oil drilling works now compared to 100 years ago, where in the early part of the 20th century, you could go to West Texas, and because of geology and the archaeology and the history of the earth, you could literally take a teaspoon and pick up oil off the surface of the earth. It was that easy. But now you need fracking, and you need 3D seismic, and you need technology and huge investment. But it's still there for the very same reason. Analogously, with machine learning, with better technology, knowing where to look, having an underlying theory of what you're looking for and why it's there, we're still finding really, really interesting patterns that are more complicated and more subtle and harder to exploit, but they're still there. So that's the types of things we mean when we talk about exploiting behavioral biases. But why are they still there if so many people are using computers? So let me give you some examples of that. The first one is people still hate to lose more than they love to win, just as Daniel Kahneman, who's unfortunately, just as most people know, I'm sure, passed this week. And it's so awful, but talk about a life well lived and beautiful influence on the world. I mean, Danny was such an incredible man, and I was so fortunate to get to know him personally. And One beautiful little tidbit I'd like to share is that he in late in life developed a great, great friendship, which actually turned into a romantic relationship with Tversky, his partner's widow. And they shared this incredible relationship very late in life after Danny's wife died, which is like, talk about a beautiful friendship. It's just such a beautiful story that the two of them managed to find this joyous relationship. So anyway, so there's the second part of that first question, which is, are there still behavioral biases in the world of systematic trading? One bias is hating to lose more than we love to win. We see that expressed in the way people design quantitative strategies that have that payoff matrix. So if I say to you, I have this phenomenal strategy, I'd like you to invest in it. It makes money 90% of the time, but boy, when it loses, it's going to lose big. It's going to lose 1,000 times your investment, and it probably will wipe you out. But boy, that probably won't happen. You probably won't invest in that. Or if you invest in it, you're not going to hear about that part. Now, of course, there are a lot of strategies in the world that do have that payoff matrix, or as some call it, the global financial crisis. But we'll talk about that later. But the idea of hating to lose more than we love to win is expressed in a lot of quantitative strategies that say very clearly, this quantitative strategy will make more in its profits than it loses in its losses. So that's one way. Another way you see it in quantitative strategies is people are attracted to and allocate to strategies that are making money recently. That's the recency bias. So you see waves of allocation to strategies that are making money and away from strategies that are losing money. In addition, because of the way firms are organized, you often see risk allocations to strategies that are making money in today's environment, rather than strategies that are designed to make money in a broader, longer term context that might benefit the firm over long periods of time. So if you can imagine a multi-strat fund, they have to be very, very careful not to allocate based on who's making money now, but based on the long-term interests of the firm. And even better, how about allocating based on the long-term interests of the firm's clients? Those are often three different things. One thing we've tried to do is optimize toward maximizing the value of our return stream to our clients' portfolios. And that's very different from maximizing to the recent profitability in the current environment. That, of course, changes how you'll perform in the event that things change. So those are some ideas about how systematic strategies, even though they're completely quantitative, can be susceptible to behavioral biases.
Why don't we talk a little bit about, alts Sharpe ratio is always the metric that investors look at. They use as a metric of consistency across different strategies. But I think Sharpe ratio comes into a difficult position for you and how you articulate that metric. So why don't you explain that a bit for how allocators can be thinking about that?
Sure. I think Sharpe ratio is great in certain contexts. If you have a lot of correlated managers doing similar things, then I think there is a lot of value, and it gives you some idea of maybe relative risk. Just for those who are a little unfamiliar, we're talking about a measure here of the return of a manager divided by the risk of a manager. Manager who takes more risk will have a lower Sharpe. Manager who has higher return will have a higher Sharpe. And it's always you're subtracting out the risk-free rate. So it's excess return above the risk-free rate, but don't worry about that so much. It's a concept basically. And when you're comparing managers to the other, so don't worry about that. So what the problem with Sharpe ratio is that you're never picking one manager in a vacuum. You always have an existing portfolio of assets. And then you're saying, okay, well, I'm going to maybe put some of my money from this portfolio in a new asset or a new manager or something. And that decision has a very different payoff matrix than just investing your first dollar. And the reason is you will add or certain risk factors by making that new investment. So if the new thing you buy has the same risk factors, even if it's got a tremendously high Sharpe ratio, if it loses at exactly the same time as the rest of your portfolio, it doesn't really help you. So another problem is if you maximize Sharpe ratio in your search for new investments, you very often will optimize toward things like survivor bias, managers who've managed to get lucky and survive, as well as some who are incredibly skillful. There are also some things about being short volatility and long volatility, kind of what I said before, strategies that make money almost all the time, but can have enormous losses. I remember a certain firm who shall remain nameless that was compared to mine in 1997. I used to see people who had gone to see them, and they'd walk in my office and say, Roy, you have 6 researchers and you have 0 Nobel Prize winners working for you. And these guys have not had a single down month in their entire history. Why would I invest with you guys? Well, I think you can probably guess who those guys were. But the issue is that there can be risks that are exogenous and haven't shown up in a manager's past that might not show up in a Sharpe ratio. So there's a lot of ways to analyze it besides just Sharpe ratio. Those include the correlation of your new potential investment to your portfolio. A strategy that has a negative correlation to your portfolio may actually be a lot more valuable in the long term in your portfolio at improving your overall portfolio. So what we like to say to clients is, don't look at the individual manager. Look at how the potential manager improves your overall portfolio characteristics. Do they protect you from drawdowns? Do they have a chance of repeating that Sharpe ratio over time? What are the chances that that's going to persist? So, and maybe a good way to think about it is if you're assembling a team of sports players, and do you want just a team of all-stars who don't play well together as teammates, if they're all going to try to shoot the ball and never pass to each other? Or do you want a team like, I always think of the Chicago Bulls with Jordan on it. It wasn't just Jordan that was making that team successful. It was the fact that they managed to get the ball to him and everybody was very, very successful as a team with a superstar. Whereas I don't think the 5 best players in the league would have done as well as that particular team did.
I would have gone with the 73 Knicks, but I understand what you're saying without question. And
oh gosh, and then they broke my heart for 50 more years.
Well, and they're still, although this year might be a little bit different, but I digress.
Oh, yeah,
I mean, but it's interesting you say that because, it's the Knicks for a long time tried to build teams, try to assemble stars, and it didn't work. This team, it's a little bit different, but they're solving for a different outcome. So I guess my question to you to amplify that answer, if you're solving for just Sharpe ratio, by definition, you're probably solving for the wrong thing, right? I mean, that should be, I guess, a byproduct of, not the answer to. Does that make sense?
Yes, exactly. So part of the problem is because of loss aversion, and this in fact happens, getting back to your first question, this is what Danny and I actually wrote our presentation that we did together on this very topic. Why is it so hard to pick strategies that have lower Sharpes and lower correlation when your behavioral bias is to pick higher Sharpes and higher correlation? And the reason is loss aversion and recency bias, we postulated. In other words, the strategies that are better for your portfolio tend to be the ones that might have more frequent losses, but actually you'll be more consistently protective and actually work better in your portfolio. So here's one very simple example. What's the Sharpe ratio of your fire insurance? Okay. And the answer is like negative infinity, but everybody has it and no one questions why you should have it. And if you think about your overall life with fire insurance or without it, your overall Sharpe ratio is much higher, and health insurance and every type of insurance that you have, even though as a standalone investment, that's the worst investment. 99.99% of people, fire insurance is the worst investment they will ever make. Negative infinite Sharpe. But we all know why we have it. It's been very difficult, to be honest, for our fund over the course of time, even though and I should point out, our fund has had a very, very nice positive return over time, but we've had also a tremendous insurance value. For those that understand this, we've had a negative 0.4 beta historically since 2000, which is tremendously protective. That's more than most short sellers. but we've made 8 or 9% annualized since then in our flagship fund. So, and our best years, 2000, 2008, 2022, all 53 to 60% years for us. That type of insurance is incredibly valuable.
When you think about how you best articulate the strategy, a few other things that come into play: duration, and RG Niederhoffer has an interesting take there in terms of your strategy. And then, well, why don't we start there? Tell us a bit about duration, how that comes into play, and how you explain that when you're talking to investors.
Sure. I think there's a fundamental reason why our strategy has this tendency to do well in these periods of volatility and dislocation. And that is that from the very get-go, because we were trying to capture these behavioral biases, we were looking for things that happened a lot. And that attracted me to very, very short-term trading horizon, meaning hours to days. Even today, and certainly back when I was starting 30 years ago, almost everybody in the space was long-term trend following, meaning making trades that lasted weeks to months at a time. And even today in the managed futures space and global macro, the typical trade duration is months to quarters at a time, not hours to days. And the trade-offs are it's harder to be a $20 billion, or probably impossible to be a $20 billion short-term manager, but you can easily trend follow with $20 billion under management. So with that short-term strategy in place, your returns tend to happen when markets get volatile on a day-to-day basis. That becomes your food that you're eating, the driver of your profits. And then if you ask, okay, well, why is it that the strategy has such an interesting return stream, particularly when things get volatile, when stocks are going down? The global financial crisis, when stocks are just moving around a lot, they're moving 4% a day, maybe even without much direction. Why does it do so well then? And the answer is that's when people are returning and are most driven by behavioral biases. We all know in general human behavior, when they're people most instinctive, when they're emotionally aroused, when they're afraid, when they're exuberant, when they are just completely, then they're not thinking, when they're not rational. And volatility begets instinct, and instinct begets volatility. It's actually a positively reinforcing cycle. So from this falls out an inherent negative correlation to equities and an inherent positive correlation to realized volatility. The more markets move, the better our opportunity set is. And of course, when stocks go down, because fear increases, volatility increases. We know that. That's why puts are always more expensive than calls. Downside insurance is always more expensive than calls. So let's turn to a chart that we've prepared. It shows a very interesting phenomenon that is quite pervasive in the hedge fund industry. And that is that there's a tremendous impact of the direction of the S&P in determining the direction of all types of hedge fund styles, whether they make money or not. So for those of you that are listening on audio, what I'm showing now is a chart that has about 30 different types of hedge fund styles, ranging from activist and long short equity, global macro, and a lot of specific ones. And then at the very end of the chart, we're showing our own strategies, which are going to have the opposite pattern. So what you'll see on this chart at the very left is the S&P 500. The blue line, that's the average return in up months for the S&P. The orange lines is the average return in down months for the S&P. What you see is that just about every strategy makes money in up months for the S&P. In fact, all strategies do fine in up months for the S&P. But in down months for the S&P, it's a completely different story. Every single strategy, with very, very few exceptions, is way down in down months for the S&P. There's only one or two strategies that have any sort of profits. Now, in our case, it's the opposite pattern, where the vast majority of our profits have come in down months for the S&P because of the volatility that we've talked about in those down months. Now, if you imagine how this fits in a portfolio, it's a very, very valuable thing to have strategies that provide that kind of return in down months for the S&P. The problem is that so many things are correlated to each other, so many hedge fund styles, even though it's right there in the name, hedge fund. You can see that hedge funds don't hedge and have not provided any sort of hedge when the S&P goes down. And in fact, I've been talking about this phenomenon for more than 25 years. I first wrote an article for Barron's in 1999 about this exact phenomenon, and it hasn't changed at all. If anything, it's gotten worse now that the S&P 500 and bonds are more correlated to each other than they've ever been before. We all know that stocks and bonds are moving in the same direction now, especially since 2020. From 97 to 2019, stocks and bonds were a pretty good hedge for each other. And that 60-40 stock and bond portfolio was a pretty good thing to have. But now, because bonds and stocks are responding to inflationary threats, stocks and bonds are going in the same direction. So this chart is going to get even worse going forward. So it's very important to think about, can you actually find diversification in portfolios, and where will that diversification come from? It's harder than ever to find, and it's our view that short-term trading, because of its relation to market volatility, is an interesting place to look to find true diversification.
It's interesting. So I'm fascinated by this. And I never ask two-part questions, but just indulge me for a second. So two of your best years were obviously two of the worst years for the broader market. You mentioned 2000, you mentioned '08, and I totally understand that. I guess my question to you is, in large part, are you seeing any parallels now? And are you not confused, are you interested in the lack of volatility as measured by the VIX, which, by the way, I would submit is not the same instrument that it probably was 5, 6, 7 or so years ago? Thoughts on that?
There are some really fundamental structural drivers that, while they're not keeping me up at night, they're keeping me up over the course of quarters and beyond. There are two things that I think are really important to think about this year. The first is that we have an election year, and typically election years since 2000 have been about 30% more volatile overall than non-election years. And a lot of really interesting things have happened in election years. I mean, the global financial crisis, '08, was an election year. The tech crash of 2000 was an election year. COVID was an election year. You can make the case that, yeah, these are all sort of exogenous. That the election didn't cause all those things. But maybe the response to those things was stronger because they were election years. So maybe that's a driver. But to me, the bigger driver is, and now, what's a short-term 1 to 3 day duration trader doing talking about 30-year macro factors? Well, I think about that stuff too, and I have a lot to say about it. The big one for me is debt, both here and around the world. And we are accumulating debt in the United States, but not just us, more rapidly than ever before. The CBO projections are so rosy. They expect interest rates to be much lower than I think they're going to be, and much lower than the market thinks they're going to be. They never take into account any sort of problem like a war or a pandemic or anything like that. They never take into account the fact that it's impossible to retract an entitlement like, say, Obamacare. Like everyone thought that was going to go away. It's never going to go away. All of these things that once put into place, they never get smaller. So government spending grows and grows and grows. The deficit is going to grow and grow. And the one thing that no one anticipated was that interest payments on the debt are going to grow and grow, to the point that we're already running, about a $2 or $3 trillion deficit right now. And that's going to grow and grow. And it's completely unsustainable. So to me, there is this driver of volatility that we've never had before. And that driver of volatility actually might not be downside volatility. Now, if you think about it, everything I've said so far has been about our ability to protect the left tail. And we sound like, oh, this guy's a downside protective guy and he makes money overall. Great. But to me, the biggest existential threat is actually the right tail, not the left tail. And here's what I mean by that. If you look at history, if you look at 1923 Germany, if you look at Venezuela, if you look at Zimbabwe, and you think about what's the extinction event for vast pools of intergenerational wealth, meaning wealthy families and endowments, and people that are trying to outlast their own lifetimes and give to their children's children. It's not market crashes. Market crashes, you can always survive a 50% decline. Eventually, the stocks come back. It's when your base currency goes down 99.999%. To me, the debt that we've accumulated and are continuing to accumulate at a more and more rapid pace poses the risk of dollar devaluation. Now, what is that going to look like? I think it's going to mean financial assets start to appreciate in a way that we cannot explain. It's not going to be like Germany in 23, where it goes up 100 billion% in a year. It's going to be like, wow, why is this thing going up in price? We don't understand why it's going up. It shouldn't be going up this much. It's ridiculous how much this thing costs. Does that sound like the S&P right now? Does that sound like some things that it feels to me like it might be starting. But if we start to hit this type of moderate to high weird inflation, that might be a trigger for us to think, okay, well, we have to keep up with the right tail, the right side. We have to make as much money as we are losing in real purchasing power. And everybody feels that around the United States. Everything is more expensive in this weird way that we can't figure out. So many investors are invested in products that are not keeping up with the price of the S&P as it goes up. The S&P keeps up with the S&P, but do long-short equity funds keep up with the S&P? Most of them make about 0.5 times the S&P with a higher risk-adjusted rate of return. They take less risk and they make about half as much. On a risk-adjusted basis, on a Sharpe ratio basis, they're fine. But will they keep up if the market really starts to go up 50, 75, 100% a year? And I think the answer is no. And here I am with a strategy that has spent most of its time protecting the left tail. So one of our challenges is, how do we survive and thrive in that environment? So over the last few years, we have made some very interesting changes to our strategy to make it two-tip rather than single-tip. So over the last few years, in a very, very bullish equity environment, I'm really happy with our performance. Our correlation is still minus 0.3 to equities. We're still just as protective as we've ever been before, but we're annualizing at 24% since 2020 with a 1 Sharpe when we've had 4 out of 5 very, very strong up years for equities, way above trend. I'm actually very, very bullish for a guy that's been so bearish all this time. I think the right tail is the risk.
Thinking about your edge, I'm curious, the nature of trend-oriented strategies is that when things move, they move quickly, and everyone who's looking at that trend moves quickly with it. So you have this problem of magnitude where what you're initially looking to do magnifies maybe quicker than you were expecting. How do you navigate that?
Trend following, which we'll call managed futures or even global macro, which it's really interesting how correlated fundamental global macro is with systematic trend following. A lot of what the fundamental view is so correlated with what the systematically captured trend is. That's, again, perhaps consensus bias at work. But whatever the reason, being able to capture those long-term trends and be on board for longer and more than one would expect is an incredibly powerful strategy. What's happening in cocoa right now? Who would have thought that cocoa would do what's done? I mean, the thing is, every day it goes up incredible amounts, and no one would have believed it. And here's a little anecdote for you. You've probably heard of the book Extraordinary Popular Delusions and the Madness of Crowds. It's a book that describes tulip mania and the South Sea bubble and every one of these ridiculous manias that have occurred in history. And it came out maybe 20 years ago. And it describes, and if you read that book, you think, what a bunch of idiots these guys were. Tulips. Who would have bought a tulip? 100x of tulip bulb for a year's salary in history. And if you imagine you had the worst possible systematic trend following or the worst possible global macro strategy in the world, literally the worst. And the only thing that thing did was buy every one of these manias up 100x. It never bought until it was up 100 times. And then it would buy it. And of course, in every one of these cases, it would have lost all its money every single time. And then in 2015 or so, it makes one more trade. It buys Bitcoin. And it's up another 100x on Bitcoin. And it's up 90 units or something like that, because it's up another 100x. And I wouldn't be surprised if it goes up another 20x on top of that. So the interesting piece about it is when you get on board these long-term trends, they can go so far and so much more than your brain is telling you is rational. And that's why it's a good strategy. Now, I am not a long-term trend follower, however. What do we capture that's different? Well, we have a piece of that. That's about 20 or 30% of what we do. The other piece of it is capturing that type of move when it occurs in a period of time lasting hours to days. And also there's an enormous amount of mean reversion trading, trying to capture when that trend seems like it's going to fail and everyone panics and says, oh, the trend is over. The cocoa trend is over. It's going to correct all the way back down. But maybe most of the time it doesn't. And so we're trying to get on board these gyrations that occur, the day-to-day volatility that I mentioned before. And that can also be captured. So one of our favorite environments that others don't often capture is extreme volatility without trend. And that can be a type of environment that's very profitable and very interesting for us that not many other managers can capture. Now, of course, there's a flip side of this. What don't we like? We don't like when markets flatline, when they just trade the same price over and over and over again. Now, who loves that? People selling one day to expiration options. That's the most profitable strategy over the last couple of years in stocks, as many of you know. Currencies have been very, very quiet. So there are periods of time when markets just don't do anything, even though we were just like, come on, do something. But when everyone's sleeping very well at night, that's probably not so good for us. So, I kind of like to be woken up in the middle of the night.
All right. So here's a question you probably have never gotten. You mentioned our brains are not wired that way, but your love of music, I would submit, has probably helped you immeasurably in terms of what you do for a living. Speak to that.
So I think there are several answers to that question. The first is that within music, there is an underlying grammar of what Western tonal music is and is not. And if you want a good example of that, there's a new AI program that is producing extraordinary, beautiful, brilliant songs in any possible style, including lyrics that are basically almost indistinguishable. I shouldn't say, I'm a bit of a critic, but pretty close to what you would listen to on the radio. And it's following the rules of grammar that it's inducing from a large database of existing songs. And there have been lots of books written on what the theory of tonal music. That same thing exists in the market. The grammar of tonal music exists because of the way the human brain is wired and the way the ear is wired and the way physics work. And it has to do with the way the piano is tuned and the way the cochlea is wired, all that stuff. The way the markets work, the wiring of human behavioral biases, again, the human brain structure causes certain time periods, certain patterns to occur in a certain way. So the way our models are created in certain ways, trades that we do make and don't make, has to do with that inherent grammar of the markets, just as certain pieces of music are pleasing or displeasing and exist and don't exist in music. So that's one way that music is clearly, I think, quite analogous to the markets. And I think there's another way, which is any musician knows that really hard work and refinement leads to tremendous success all the time. And you need to improvise. So it's a combination of both. and even classical music, which sounds like it's just the same way. For those who don't understand it, that you're doing the same pieces over and over again. No, every performance is different. You're always going to have to do new things as well. And the most interesting stuff is new. And I would say especially in live performance, there are going to be times when things happen, especially in non-classical styles. And I'm a jazz musician and I do a lot of things with theater as well, where you really have to do things that are completely not in the score, and something happened and you just have to go with it and figure out what to do. And the markets are like that as well, that they will throw things at you that are not in the database, that you've not seen before. And you need to use your skills, all that training, all your ability to get through those situations effectively. And it can be something like a market crash. It can be something like the Fukushima earthquake and tsunami. It can be something like an election night where this election is such an important one that no VAR model in the world is going to understand it the way someone who's really thinking about politics is going to understand it, et cetera. So that's another way, that being able to improvise and also react when your bass player and drummer start playing a different tune than the one you prepared, you better be able to play that tune too.
Has that changed the influx of AI and machine learning, but this balance with needing human capability as well? Has that changed how you think about building out talent within the firm and who you're hiring?
Okay, those are, again, two different questions. So has better AI changed the way we approach things, and then the types of things that we're looking at? We've gradually incorporated AI over the last, I'd say it's coming up on 10 years now. What AI has, let's call it machine learning, because it's a little bit different. It's allowed us to get a lot more comprehensive in our descriptions of what each day and each hour looks like. So it's enabled us to maintain the robustness of our models and include a lot more about what's going on, to measure more, have different ways of taking the emotional temperature of the markets without overfitting the data. That's always your bugaboo when you're doing researching historical data. You don't want to overfit. And AI models are really good at overfitting, but they're not very, very good at generalizing as a broad generalization. So you have to be really careful of that. So if you're careful, and the way we do it is we choose the variables. We don't let the computers choose the variables. A lot of people are doing it the other way. They're letting the computers choose the variables. That can be done, but you have to be extremely careful and not to let the computers go too far. And the way we've solved it is we want everybody who does any research to have direct trading experience. So it's a little bit like if you were working for Elon Musk and you were doing research on self-driving cars, and your process was to show the computers lots of videos of people driving, which is what they're doing right now, in order to teach the computers how to do self-driving. But you didn't know how to drive and you never sat in a car before. Would you be as effective as somebody who's driven 1 million miles in all types of weather conditions? And my answer would be no. Someone who's driven a dirt road in Vermont in the middle of a snowstorm at night, or somebody who's driven down East 93rd Street in the middle of Manhattan when there's someone blocking the street and you have to back up your car and get out of your car and wave and yell at people to get out of here, get me out of here. That situation, if you've never experienced that, no inductive technique is going to be able to find that. So my view is you have to have direct experience. And I use aviation sometimes as a good metaphor. You have to know how to fly an aircraft before you design an autopilot. So always our skill set is, you sure, quant finance and AI, computer science, great, but you're going to learn to trade. And if you know how to trade and you've tried to make money using trading, and you know AI, and you know how to program well, okay, now we're talking.
So the question I'm about to ask you would elicit I object, Your Honor, from the opposing counsel, but in some very strange way, the advent of all this AI and everything that's going on actually works to your benefit, not to your detriment. True or false?
I think it's both. I think it can benefit us in that it gives us new techniques to look at, but I think it can also be detrimental in that it can make it a little easier for people to do what we do. So I'm not quite sure which way it's going to go. It's a challenge. The markets are always getting smarter. They're always getting more efficient, but I think it's also allows us to get smarter too.
Well, I ask that in the context of it allows people, lazy people will get lazier. People that are constantly challenging themselves will find ways to utilize this in a challenging way, which I guess is why I think this actually works to your benefit.
Yes, I think there will be a lot of people who have overfitted models that look like they're going to do great historically and don't. And I also think that there's a tremendous risk in things changing. And we spend an enormous amount of time thinking about what's not in the database. That's so important. What's not there, not what is in there, and how can we fit it better? How can we make more money on what is there? And that is such a different way of thinking about it than I think your typical way of looking at things. Like, think about how large language models work. You're trying to constantly find more data of what has been said by humans. Give me more tweets, more books, more everything, real data. And we're saying, no. We're looking for things that have never occurred before. And how will our models do on that? That's what would be interesting. So it's really the opposite paradigm.
Roy, this is a fascinating conversation. We've enjoyed our time with you. Obviously, thank you for Kaitlin for setting this entire thing up. I mean, your record speaks for itself. And my sense is this could be one of those years that sort of mirrors those other 2 years we talked about earlier. So thanks for joining us, Roy.
My pleasure. I really appreciate you having me. And, again, I don't know if it will be or not. The beautiful thing about what I've done is that what we try to do is we try not to make a prediction about what's going on. And what one has to do in thinking about this type of strategy is think of it in not just is now the right time, but is the next 5 or 10 years going to be the right time to keep a strategy like this for the next 5 or 10 years? Again, like an insurance policy, you can't really predict when the next forest fire or the next, gas main explosion is going to be. But you just kind of have to keep it in there. And in this case, we have to think about both sides, not just one side. And that, if I have one thing to get across to all the viewers today, it's that the world is a two-sided world, not a one-sided world, and it's both directions in stocks and bonds. And to think about your portfolio and say, how will my portfolio survive? Not just if everything's stable, but if stocks go way up, stocks go way down, or bonds go way up, or perhaps even a return to inflation and bonds go down again.
Thank you, Roy. This was great.
Thanks, Roy.
Thank you.